Welcome to the first episode of Ask Mike, a new segment of AMS Spotlight where we sit down with AMS Mortgage Servicers founder and president, Mike Covery. Now, Mike has spent decades helping borrowers building a mortgage company from the ground up and navigating every type of market imaginable. In this series, we're going to tap into that experience and get his perspective on the mortgage industry, housing market trends, loan programs, and advice for both consumers and real estate professionals. Hey, Mike, thanks for being here today. All right, so for people who may not know you, tell us a little about yourself. What's your background and how did you get into the mortgage industry?
I've done these kind of meetings and webinars and seminars for people, and we always wind up asking, how did you start? And everybody in this industry has a story. I was going to college, and my now present wife came into the dry cleaners where I was working, and I thought she was hot, and I still think she's hot to this day. One thing led to another, and we started dating, and to find out her father owned a mortgage company, and I wound up going to work for him. And I saw a lot of people there. Some people I know to this day, some people who work at AMS Mortgage to this day. This is in the late 80s, 1988. I wound up going to work for my future father-in-law. And I saw the mortgage banker model. I looked at it and I said, there's only one of two ways this survives. Either you become very small or you become gigantic, because the industry was evolving very quickly at that time, even faster than today. And what wound up happening was my wife and I, when my father-in-law decided he was going to retire, said, let's go try something for ourselves. And we opened a mortgage brokerage. And at the time in New Jersey, mortgage brokerages were not popular. Everything there was a big divide between mortgage banker and mortgage broker, and mortgage brokers were frowned upon, and mortgage bankers were, the heroes. And I'd like to say that we kind of changed that a little bit in the state over the years, over the past, 35 plus years. But that's how I started in the industry.
What would you say some of your biggest challenges were in those early years?
Changing mindset. Why go work for a mortgage broker when you can work for a mortgage banker? Because the mortgage banker approves their own loans, where mortgage brokers don't. And, you're always going to be subject to the banker, and the banker is always better for the consumer. And a lot of consumers felt that way too. It wasn't till about 10, 15 years of really pounding the pavement where we saw the mindset and the philosophy change. And I think a lot of it had to do with demographics of where we are, regardless of the thought process. The New Jersey, New York, Pennsylvania metro area is rather conservative when it comes to finances and the way people perceive things like getting a mortgage. I remember my father, when he needed a mortgage for a property in the early 2000s, his comment to me was, why would I go to you when I could just go to the bank? And I said, because I can be faster and cheaper than the bank. And his comment was, how can you be cheaper when they're the ones lending the money? And it's very simple. Banks have a lot of overhead that they have to cover, where a mortgage broker doesn't have a lot of overhead. So we can be cheaper. In most recent years, we've used the analogy to get people to think about it. Picture a giant oil tanker in the ocean, and that's a bank. And when they have to make an adjustment or a movement, they can't move very quickly. Picture a mortgage broker like a little speedboat. We can make adjustments very, very quickly for the consumer. But it took a very long time to get people to understand that was an option available to them, and that it wasn't going to hurt them financially in their quest to buy a house. So that was probably the biggest thing we had to come across. And that message has become loud and clear throughout the country. We're in a situation where close to 30% of all originations are done by mortgage brokers. And that's up from, when I started, it was less than 5%. After the Great Recession at the end of 2008, it was down to around 11%. We're up to 30% of the market share, because it's a faster, cheaper way for both banks to be able to do loans and for consumers to do loans.
Wow, that is some. I didn't even know those numbers. 30% is big, and and I guess that just shows how competitive the fields really come. Because most people, like even 6 years ago, at least in my experience, were more comfortable with banks. I was scared about coming over to a brokerage again, but now it's just they're the biggest names in the industry. Those are the ones that are competing the most. I don't have any pushback when I tell somebody I'm a broker.
No, and now the people who are shopping, the consumers, the realtors already know now. The realtors are fully aware. The financial planners are aware. The attorneys are aware. The consumers now are starting to read very positive articles online because that's their first place to shop. That's where we all go for information right now, is we go online and we check things out. First, we check out the process and what goes on. And again, consumers, the internet can be a fountain of misinformation as well as information. We have to use our heads to kind of weed through it a little bit. But when we go through the internet and read these articles, we're starting to read some positive things about mortgage brokers being able to help out a consumer. I mean, look, if you're a consumer and you have a less than ideal credit history, why wouldn't you want to go to somebody who can place your loan with several different banks at the same time and allow the banks to compete for your product, for you, the consumer, instead of going to a mortgage banker or a bank and having one option only, and hoping that that's the best option. And that's really truly the difference. That's the service that you as a consumer want, and that's what you're paying for. I mean, you're going to pay the mortgage banker the same amount you're going to pay the mortgage broker. You're going to pay the mortgage bank, or you're going to pay the bank probably more than you're going to pay the mortgage broker. And you're still not going to get the service that a mortgage broker should be providing you that the rest really don't provide you.
Right. So
So,
I was very surprised that even like 2 years ago, kind of switching gears over here. I
mhm.
was surprised when I found out how much of a market share AMS had in New Jersey. Did you imagine AMS would still be growing decades later after you started it?
No, it was a pleasant surprise to see where we were. And it's a testament to the people who work at AMS Mortgage. They're professionals. They understand what a consumer needs. It's really, at times you can be emotional about it because this was a little thing that we did so that we could try and do something for ourselves close to 40 years ago. And now when we wake up, it's you're talking to intelligent individuals, you're finding out what they need for consumers, you're listening to consumers and what they need from their mortgage entities. AMS has grown to a level where it's been quite shocking, to be honest with you. I mean, when we found out we were originating more loans in New Jersey than other entities as a mortgage broker, that was purely coincidental because our focus wasn't on being number one. Our focus was providing a great product and a great environment for our people to work in. And it just happened. So no, we had no idea that, we were going to be in number one. We just kept doing what we do every day anyway. And we still do that to this day. We still do the same stuff. It's not like we went to number one and it went to your heads. No, we was continue to focus. That's why we're trying to constantly give back to communities as well as employees, as well as, the consumer. Just straight education and talking to people about what they really need to do and not do in life if they want to become a homeowner and stay a homeowner, or maybe they want to buy that second property or the third property. How do you educate someone to get involved in real estate? Because at this time in our lives, there is a clear divide between generational wealth and just income. And people who have generational wealth generally have real estate holdings. It's very odd that they don't. And you can sit back and you buy a property and maybe you want to buy an investment property. I mean, there was someone I met about 10 years ago, and his comment to me was, my retirement plan is I want to have 6 or 7 investment properties, and I want to get my income off of that, passive income, I mean, that's the term of passive income. I want to get my income off of these properties for the rest of my life. That's what I want to do because I'm a regular Joe worker. I mean, I don't have a pension. I don't have a 401k. I want to be able to do something and I want to start doing this now. So we devised a plan. We sat back and talked about how you could do that. And he did it. And now out of the properties he actually has 8 properties and he's reinvested into those properties every single year to the point where 6 of them are already paid off in full. And he's almost at his plan now, which is to own all these pieces of real estate and have them pay him monthly so that he doesn't have to worry about retirement. Because at the end of the day, people need a place to live. I mean, it sounds so obvious, but it's true. That is the only thing we need a place to live. We need food on our table to eat. Most need a car and just about everybody has to pay taxes. So those are pretty much the unique qualifiers. So he found a way to do that. And that was a game plan we worked out together. And if you're dealing with a mortgage person and it's just a transactional relationship, a one and done, you're probably working with the wrong person. I mean, that's really the bottom line. You're probably working with the wrong person.
Yeah.
It's got to be more than a one and done.
Yeah, 100%. So one of the questions we probably get asked all the time as brokers is, where do you think rates and housing are headed when you look at the market over the next few years? What do you think happens next?
Okay. So the honest answer, and you always love the people who say the honest answer because you're always going to create, well, is there a dishonest answer? But the answer really is nobody knows. I mean, that's point blank, nobody knows. The internet will have 1,000 different conflicting opinions. Social media and the real estate sections of social media or the mortgage sections of social media have conflicting opinions. The bottom line answer is nobody really knows what's going to happen. Me, like everyone else, I have my opinion. But remember, we're all guessing. We're honestly all guessing. What I see with rates based on data that I've seen, I've looked at marketplaces, I've looked at inventories, and let's face it, we see what goes on with our present political climate, is that I think rates for the most part over the course of the next 12 to 18 months are going to be relatively stagnant. I think they're going to be where they are now within about 0.25%. That's really where I see rates going to be. Every time we see something that should bring rates down, something happens where rates start going back up again. So I try and tell people the following. If you really want to have a guide on the rates without being a mortgage professional, keep an eye on the 10-year treasury. Use that as your benchmark. As that number goes down, interest rates will come down at a relatively at a very slow pace. As that number goes up, rates will go up, and rates will always go up faster than they come down because there's always a hedge. People are always wondering if the 10-year treasury is going to stay down. If you follow what the 10-year treasury has done in the last 30 days alone, you'll see it looks like an EKG machine. It's a little up, it's a little down. It's a little up, it's a little down. And I think that's going to continue for the next 12 to 18 months because there's really not any great economic data that's going to keep it going down, nor is there any bad economic data that's going to really send it up. Now, let's keep in mind, if we start getting inflationary reports coming out that there's too much government spending, because that's really what an inflationary report is, there's a lot of government spending, it leads to a lot of spending in other categories, and inflation goes up, we're going to see higher interest rates. It almost has to occur. And that's in anticipation of the Federal Reserve raising rates. See, the mortgage market is always going to move faster than the Federal Reserve. So the Federal Reserve can keep rates stable and you can watch mortgage rates go down. The Federal Reserve can lower interest rates and you can see rates go up because the mortgage industry at this point in our careers is moving faster than the Federal Reserve. The Federal Reserve is being very cautious because of inflationary tendencies that happened post COVID. So we're going to move faster than the Federal Reserve. By the time the Federal Reserve makes a change, it's already too late. Rates probably will start creeping up and you'll miss your opportunity.
Yeah.
So talk to your mortgage people if you're looking about where rates go. But I don't think that they're going to go very, very, very far, very fast. I think they're going to be relatively stable.
Yeah, and I think that is one of the biggest points of confusion because how many times do we get a call the moment the Fed cuts rates? Like, hey, I heard rates were cut, and I was just like, that that was already assumed 2 weeks ago. They're actually higher today.
Yeah, and what people need to understand is that the Federal Reserve, when you hear about their when they have their Fed meeting, and there was a Fed meeting a week ago, and they kept the rates stable. What we wind up finding out, Joe, is that consumers and media like to state, well, the Federal Reserve kept their rates stable. That means that there's going to be no change in, your credit card rates or your mortgage rates, and that's not true. Many of those other creditors are not tagged to what the Federal Reserve does. Remember, that's the Federal Reserve funds rate. That affects generally the cost of money from one bank to another when they want to borrow money from the Fed. It's not from when the consumer wants to get a mortgage. So it does have a trickle down effect somewhere down the line, but it's not a linear effect on one another. Just because one goes up or one goes down does not mean that the mortgage market does that. It does have a greater effect on second mortgages or HELOCs than it does on primary residence mortgages that are backed by mortgage-backed securities. I don't want to get too I don't want to get too in the weeds and too nerdy on this whole thing, but that's really where it comes from.
But it's good information, I mean, it helps a lot of people who are rate sensitive, which does also lead us into question number two. If you were talking to a first time home buyer who's waiting on the sidelines, what would you tell them?
The simplest answer is buy now. I have a statement. There was a new loan officer who came to work for us, and the biggest problem that a lot of people get in their heads now is that whether it's a loan officer or a consumer or realtors, I actually saw a realtor do something on YouTube once where they said it's not the time to buy, and it is the time to buy. Anytime you're able to buy, buy. That's what you should do. You should buy because there is so limited inventory that's out there to start off with that you want to buy. You want to be in a position, if you have that opportunity, take what's out there, because with lower inventory, you're going to see housing appreciation. Remember, you do have to live somewhere. So the story I usually tell people is I have a relative who bought a property just as rates were starting to go up in early 2023. It had already gone up a little bit. The rates were right around five and a quarter, which was, people were freaking out. I mean, the rates were just 3%. Now they're five and a quarter. And people were like, well, I'm going to wait till they come back down. First and foremost, the only reason why they were so low was because of a global pandemic. So if you want rates to be that low again, we need another global pandemic. That's the logic that you're exercising there. So do we really want another global pandemic? I don't think we do. So we have to look at what normal rates are. The rates today on a historical average are lower than the averages dictate they were over the course of the past, if we go back 30 some odd years. I mean, the early 2000s, where we saw that big boom, rates were consistently 7% in the early 2000s, right before the Great Recession. The rates now are in the low sixes, high fives. So early 2023, I had a relative who didn't know whether or not she wanted to buy a house. And we talked about it, and I told her the same thing, buy now if you can. And she did, and she bought a house for $500,000 in New Jersey. And she got an interest rate right around 5%. And after she bought it, the rates kept going up to where, they were approaching 7% at one point. But the interesting point about this is in the last 3 years, her property has appreciated 150,000. If she decided to wait, like so many people did in early 2023, she wouldn't be in that equity position. She wouldn't have that available to her. If she wants to sell the property, she could sell the property now and have a nice windfall because she decided to buy. I don't see real estate becoming more affordable. I do not see real estate crashing. There's a lot of articles. We're going to wait for the housing crash. There's going to be another housing crash. In order to have a housing crash, you need foreclosures to skyrocket. Now, although foreclosures are up, the reason why foreclosures are up is because we stopped doing foreclosures during COVID. So, of course, foreclosures are up. They have to be up. There's no alternative to that. Eventually, people who don't make a payment are going to have to lose their properties. That's just, you can't have them living there for free. So eventually that's what's going to have to happen. So yes, now's a great time to buy a house. There's still a demand. There's more houses on the market now than there were a year ago. That is a fact. But we're still at levels that are about 40% of where they should be. Read an interesting article recently in regard to the Los Angeles basin, which is essentially LA County and Orange County and sections of San Bernardino and Riverside counties. They have doubled the amount of houses that are currently on the market from 2 years ago. And they're still only at 41 of the normal amount of listings. So even though they doubled listings, they're still 59% below where they're supposed to be for the amount of listings in a normal real estate market. And this is typical in any area where there's a high density of people. Northern New Jersey has it. New York has that. Pick anywhere around cities, you're going to find that they're still below normal levels. Of course, there's outliers, but generally speaking, if you're a buyer now and you have the ability to buy, or more importantly, you want to buy, you should buy. And you should talk to somebody that can educate you on how to do it in a way where you're comfortable with not only the house you're buying, but the payment you have to make. Because remember, you're the one making the payment. We can give you all the data in the world, but if you're not comfortable with the payment, then it doesn't matter because you are the one making the payment.
So, moving on to our last question, what's the first piece of advice you give them?
Brand new loan officer.
Brand new.
A brand new loan officer in today's market, it's a lot different than 1988 when I started. In today's market, a brand new loan officer, the first thing they need to do is they have to check their ego. It's not like any other job that you do. To be a brand new loan officer and not have any business and looking to start business, you have to realize that it's going to take 6 to 9 months for you to get any business right out of the gate. So you need to be patient. You can be the smartest person in the world, but you have to be patient because most people that you're going to get a referral from or business from, those individuals already have business contacts that they're working with. So you can be the greatest person in the world, but it might take you 6 to 9 months to get business. And that's the first piece I would give you. I think the smart loan officer, the smart individual, I should say, who wants to get in this business, the first thing that they should do is they should, besides get licensed, because that's important.
Yeah.
But what they should do, yeah, obvious, right? But what they should do, Joe, is that person should decide they want to work underneath a loan officer as a loan officer assistant. And I think the reason why that's important is they'll in turn gain a lot of street smarts that way versus book smarts. They'll learn how to talk to a consumer, how to talk to a processor, an underwriter, a realtor. They'll also get a little compensation coming their way because they're helping out on a transaction. They become part of a team, if you will. That team concept seems to be very popular nowadays. But in this particular case, I would recommend a brand new loan officer to become part of a team. They can learn, they can get some money in their pockets, and in the same time, still work to try and build their own book of business. Because now they can talk about successes that they've experienced firsthand, which is important. A lot of people who are doing a loan, especially a tough loan, don't understand when they've actually had a successful moment or not. I talk about this all the time in our regular training classes. And that's the other thing they should do. They should become sponges, learn as much as they can and pick everybody's brain around them if they can, because they know what's in a book and they know what's in a guideline and in a matrix, but they don't know what's out there in the real world. They haven't had that life experience yet. And consumers would rather deal with someone who has a life experience. Remember, a mortgage is not like going into the supermarket and buying a gallon of milk or a dozen eggs where you're looking at six different, farms that have the eggs and you're saying, okay, which one is the cheapest eggs? Because I just want eggs. I don't really care whether they're farm raised or organic or whatever. I just want eggs, and this dozen's cheaper than all the rest. This is the biggest purchase of your life as a consumer. You need to listen to what the people are telling you, and it goes well beyond what are your rates and your fees. If you make it a transactional process of just rates and fees, you're going to establish yourself as someone, you know, who just can't be able to help consumers, but rather just take an order. And that doesn't have a lot of staying power in this business. It really doesn't. You know, you that's one of the issues that I have with new loan officers. I think with loan officers who have started out and had a taste of closing loans, my biggest suggestion to them, these are the people who might close 12 loans a year, 12 to 24 loans a year. My biggest suggestion to them is learn how to sell, not just take an order. Learn how to sell. Learn and understand when you're doing something really special and being able to tell people that you've done really special. In today's day and age, we see people on social media just closed another loan, just funded this, just funded that. And we believe that the consumers or the realtors, that makes them feel like we're really, really successful. It doesn't. At this point, it's oversaturated market. Consumers and realtors know that, this is just way too much. You need to be able to explain your successes. You need to be able to talk to people that you've explained your successes to and actually tell those people, hey, this loan doesn't close if I wasn't able to get the right information from the consumer, be able to explain that information correctly to the underwriter. So the underwriter understood the mitigating circumstances that went on in that consumer's profile and see that they're credit worthy. And most loan officers don't do that. Most loan officers just decide, hey, I closed the loan, everybody should be happy. And by attrition, I should get more referrals. That doesn't happen. Think about it. How many times have you asked somebody for a referral of somebody, hey, can you send me a good electrician? Can you send me a good painter? What have you? Yeah, I can give you a name, and you never get the name. Or you get one name and they're really not good. They're overly expensive and you're never going to use that person. You need to be in a position where people understand that you're the person who gets things done. And that person who's closing between 12 and 24, maybe even 30 units a year, they're doing business somewhat afraid, and they don't need to be afraid. They need to actually show everybody what they're made of and how good they really are. And that's the suggestion I would give them.
Great. All right. Well, we're almost wrapped up here, but we do have the lightning round. What's one mortgage myth you'd love to eliminate forever?
The lower the rate, the better the loan.
Okay, great. Number two, if you could give every borrower one piece of advice before they start house hunting, what would it be? Just one.
I actually give them three, Joe. So you're going to get three.
Okay.
First and foremost, if you're going to buy a house, first thing you need to do is do not deposit any cash into your bank account. Can't do it. We won't count it. It'll be a nightmare for you. Number two, don't change your job. Don't do it. Talk to your mortgage professional and say, hey, I've got this great opportunity to switch jobs. Will this hurt me in getting a mortgage? Talk to them. And last but not least, don't buy anything. You don't know how many loans in my career that I've seen people buy furniture for a house before they got the keys for the house. They've bought cars, motorcycles, hot tubs. I had somebody buy a boat. All of those things wound up making the client no longer qualify for a mortgage. I actually had to have somebody send the furniture back. I remember one client, a veteran buying a property, bought all the furniture for the house after he was approved, but before closing. And we found out about it through checks, because there's going to be checks right up until closing. And yeah, I bought all this furniture. They were having a Columbus Day sale. I went, well, Guess what? You got to send it back. He goes, what do you mean? I go, you got to send it back. I said, send it back. And you got to get that wiped out because you no longer qualify. So those are the three things that I tell every consumer I talk to.
Yeah, great advice. And the last one word to describe the mortgage market in 2026.
The mortgage market in 2026. I'm going to tell you it's opportunity.
Okay.
I think
That's
there's
a solid answer.
I think there's opportunity out there that people don't realize because they're not scratching below the surface. They're just looking at the surface and they're not scratching below. And what's happening is institutional investors are buying properties that consumers could have opportunity at. As a matter of fact, they just passed the housing affordability bill today, and it's going to the president for signature. And part of it is trying to force institutional investors from buying properties to have more properties for consumers. So I think there's opportunities out there for consumers, but they have to look and they have to realize that when they're buying a house, especially their first house, that it may not be the house of their dreams. They might by buying a house, but it's up to them to make it a home. And for a lot of people, they don't they don't understand that. They understand I'm buying a house, not making it my home.
That's great advice. And that wraps up our first Ask Mike segment. So, if you have questions you'd like Mike to answer in a future episode, leave them in the comments or send us a message. We'll be back in 2 weeks with another Ask Mike right here on
Sure.
AMS Spotlight, and I'll try to give you a better heads up next time.
You know what? Love to do it, Joe. I can't wait for the next time we put this together. It'd be a lot of fun.
Perfect. Thanks everyone for watching, and we'll see you in the next one.
Take care.